Futures and options. You've probably heard the stories, right? Tales of people making fortunes overnight and, well, losing them just as fast. We're talking about a massive multi-billion-dollar world here. But it's all built on a huge paradox. And today, we're going to pull back the curtain and figure out exactly what's going on.
You know, the first thing you absolutely have to understand about this market, it really just boils down to a single, pretty shocking number. 9 out of 10 individual traders in the futures and options segment lose money. That's right, let that sink in for a second. Market data shows that a whopping 90% of regular folks like you and me who try their hand at this, they end up losing their money.
And that leads to the big mystery, doesn't it? If the failure rate is so incredibly high, why on earth is India the world's biggest market for F&O trading? I mean, by a huge margin. What's the magnetic pole that draws so many people in? Well, let's find out.
So, to get to the why, we have to start with the what. First up, let's decode derivatives. And I promise you, the basic idea here is actually way more straightforward than it sounds.
Okay, so here's the textbook definition. A derivative is a contract, and its value is, well, derived from something else, like a stock or gold. Yeah, I know, that sounds super boring and academic. Let's use a much better analogy. To make this really simple, just forget about the stock market for a minute. Think about something you probably have in your wallet right now, a credit card. Those reward points you earn, they are a perfect real-world example of a derivative. Here's how it works. Your credit card, that's the main asset. The activity is you going out and spending money with it. And the derivative, that's the reward points. See, they literally can't exist without the card, and their value is totally dependent on how much you use it. No spending, no points. It's that simple. That dependency is the whole key. All right, so now that we get the basic concept, we have to talk about something crucial. This is where a lot of people get tripped up. Trading in F&O is not the same as just buying stocks. The rules of the game are totally different. Let's just put them side by side. So in the regular stock market, the cash market, you buy an actual piece of a company. There's no expiry date. But in the futures market, you're trading a temporary contract that has a ticking clock, an expiry date, and you have to trade in these fixed bundles called lot sizes. Let's zoom in on those last two because they're the most important. First up, expiry. This is a total game changer. You can buy a share of a company and hold on to it for 50 years if you want. A futures contract, though? Nope. It's temporary. It has a hard deadline. Once that date hits, that specific contract is just gone. Poof. Forever.
And second, the quantity. In the regular market, if you want to buy one single share, you can. But in F&O, you have to trade in these preset bundles or lots. So for a big stock like TCS, for example, one lot is 175 shares. You can't buy one, you can't buy 10. You have to trade the whole bundle. And believe it or not, this little detail is what unlocks the entire paradox.
Okay, this is it. This is where everything comes together. We're getting to the absolute heart of F&O trading, the power of leverage. This one concept is the reason for the incredible attraction and the devastating risk.
So to really get this, let's just run a quick scenario. Imagine you have 1 lakh rupees, 100,000, and you're ready to put it in the market.
And this is where you see the mind-blowing difference. In the regular stock market, your 1 lakh can buy you about 33 shares of TCS. Okay? But in the futures market, that same 1 lakh lets you control a full lot, 175 shares. That's more than 5 times the exposure for the exact same amount of money. So, what happens if the stock makes just the tiny move? Let's say the price goes up by just 5 rupees. How does that tiny change affect your investment in both of these situations?
And check this out. In the cash market, with your 33 shares, your profit is 165 rupees. Not bad. But in the futures market, because you control so many more shares, that same 5 rupee move gets you 875 rupees. The potential for these huge gains is enormous, and this is the appeal of leverage. This is the siren song.
But, and I need you to really hear this, this is the most important part of our entire conversation. This amplification is a double-edged sword. That same power applies just as much to your losses. A 5 rupee move against you means a devastating 875 rupee loss. And that is the trap. That is how we get to that 9 out of 10 statistic. So, let's tie this all together with the most important takeaways. This really is a double-edged sword, and here's what you absolutely have to burn into your memory before you even think about touching this market. First, remember you're just trading temporary contracts. You don't actually own the asset. Second, these things have an expiry date. They have a limited shelf life. Third, and this is the big one, leverage is an amplifier. It makes everything bigger, the good and the bad. And finally, because of that, you have to be right about the direction of the market, and you have to be right now.
So, we're back where we started, with that billion-dollar paradox. The chance to build a fortune with just a little bit of capital is what makes F&O the biggest market in the world. But that exact same power can wipe you out in the blink of an eye. So, ultimately, the real question you have to ask yourself isn't how much can I make, it's how much am I truly prepared to lose.